Compare 30-year mortgage rates today. Today's national 30-year mortgage interest rate trends. For today, Friday, October 25, 2024, the current average interest rate for the benchmark 30-year fixed mortgage is 6.80%, increasing 25 basis points since the same time last week. If you're looking to refinance your current mortgage, the current average 30-year fixed refinance interest rate is 6.77%, increasing 23 basis points since the same time last week. Mortgage rates have shifted around but remain elevated. In 2024, experts were predicting the 30-year mortgage to slowly shift down, eventually landing under 6%. Mortgage rates change constantly, however, and many factors could play out between now and year-end to change those projections. Check out our mortgage rates forecast for the latest mortgage rate news this week, October 24, 2024. 30-year mortgage rates move above 6.75%. The average rate on a 30-year fixed mortgage again rose this week, up to 6.78%, according to Bankrate's lender survey. Mortgage rates rose despite the Federal Reserve's recent rate cut. The Fed doesn't set mortgage rates, but its decisions move markets that influence them, including the 10-year Treasury yield, the general benchmark for 30-year fixed mortgage rates. This shows that the Fed does not control long-term interest rates like mortgages, says Michael Becker of Sierra Pacific Mortgage. How to get the best 30-year mortgage rate. If you compare loan offers from a few mortgage lenders, you'll have a better chance of landing a competitive rate. Here's how. Decide whether a 30-year mortgage rate is right for you. The 30-year term is the most popular option, but it's far from the only one. Depending on the lender you work with, you might be able to apply for fixed-rate loans amortized over anywhere from 8 to 29 years. Get pre-approved. Get rate quotes from at least 3 mortgage lenders, ideally on the same day so you have an accurate basis for comparison. Lenders determine your interest rate based on your credit score, debt-to-income DTI ratio and other factors, including the size of your down payment. Compare the interest rate and APR. The interest rate and annual percentage rate APR reflect the cost of the loan. The interest rate is the cost to borrow the funds, while the APR includes the interest rate and other costs such as the origination fee and any points. Consider the lender's ratings and your experience. Aside from the numbers, evaluate lenders for convenience and responsiveness. Take a look at what other borrowers have had to say about the lender, too. How are 30-year mortgage rates determined? There are many variables that go into the cost of a 30-year mortgage, including the individual mortgage lender, your credit score, your debt-to-income DTA and loan-to-value LTV ratios, the loan amount, the type of property being financed, 10-year Treasury yield, economic or geopolitical influences, inflation. Pros of a 30-year mortgage: lower monthly payment. Repaying a mortgage over 30 years means you'll have lower, more affordable payments spread out over time compared to shorter-term loans like 15-year mortgages. Stability. Having a consistent principal and interest payment helps you better map out your housing expenses for the long term. Your overall monthly housing expenses can change, however, if your homeowner's insurance and property taxes go up or down. Of course, this is only true if your mortgage has a fixed rate. An adjustable rate mortgage won't give you the same benefit for the whole life of the loan. Buy more house. With lower payments, you might be able to qualify for a larger loan amount and afford a more expensive home. More financial flexibility. Lower monthly payments can provide more cushion in your budget for other goals, like saving for emergencies, retirement, college tuition, or home repairs and maintenance. Cons of a 30-year mortgage. More total interest paid. Stretching out repayment over 30 years means you'll wind up paying more in interest overall than you would with a shorter-term loan. Higher mortgage rates. Lenders usually charge higher interest rates for 30-year loans because they're taking on the risk of not being repaid for a longer amount of time. Becoming house poor. Just because you might be able to afford more house with a 30-year loan doesn't mean you should overstretch your budget. Give yourself some breathing room for other financial goals and unexpected expenses. Slower equity growth. It will take longer to build equity in your home because most of your initial mortgage payments will go toward interest rather than paying down your principal amount.